Welcome to this explainer. Have you ever just looked around and wondered why the wealth gap seems to completely defy logic? I mean, why do some people effortlessly compound their net worth year after year, while others, who are honestly working harder than ever, still struggle just to gain ground? You see the wealthy scaling businesses, dominating real estate markets, expanding their portfolios, and somehow their capital just multiplies.
It kind of makes you stop and ask, is it just luck? Is the whole system inherently rigged? Or do the wealthy simply play a completely different game, governed by a totally different set of rules? Well, that is exactly what we're going to unpack today as we decode the mechanics of lasting wealth.
Okay, let's dive right into this. Section 1, the income illusion. So here's the thing. Most people mistakenly track their success by looking at their monthly paycheck. But the wealthy, they track their net worth. Income is really just the cash you trade your labor for. True wealth, on the other hand, is defined by the assets and the equity you actually retain and own. If you want to understand true financial freedom, fixating on a high salary is, well, actually, it's entirely the wrong metric.
Now, what's really interesting about this is the stark visual contrast. Think about it. A high earner pulling in six figures can still be fundamentally broke at the end of the month if their lifestyle inflates to consume every single dime, right? Contrast that with an investor holding a portfolio of valuable assets. They aren't just trading time for money. They are quite literally generating wealth while they sleep. The wealthy inherently understand that a huge salary absolutely does not automatically equal true wealth. Which brings us to Section 2, assets over liabilities. One of the primary reasons the rich just keep compounding their net worth comes down to a single powerful concept: ownership. While most people work to earn cash, the wealthy work to acquire things that print cash. We're talking about high-yield real estate, equities, scalable businesses, and intellectual property. The defining magic of these specific assets is that they do two things at once. They generate passive income, and they actually appreciate in market value over time. But unfortunately, on the flip side, many people take their hard-earned income and buy liabilities. These are things that rapidly lose value literally the second they leave the store or drive off the lot. Luxury cars, the newest trendy gadgets, fast fashion. They actively consume your wealth through depreciation and maintenance. People inadvertently trap themselves in this cycle of buying things that drain their balance sheet rather than expanding it. So the golden rule of the wealthy is remarkably simple. Prioritize assets first. They build this absolute fortress of income-generating investments before they ever indulge in things that consume cash. And eventually, the cash flow from those acquired assets is exactly what pays for the luxury liabilities down the line. It's a real game changer. All right, moving on to Section 3, the compound growth engine. Albert Einstein supposedly called compound interest the eighth wonder of the world. Now, whether or not he actually spoke those exact words, the historical principle behind the quote is monumental. It represents this invisible, exponential force that heavily favors those who deploy capital over time. And this brilliantly illustrates exactly how that works. The real magic lies in an infinite loop. You invest your capital, that money earns a return, and then, and this is absolutely crucial, you start earning returns on those returns. Over time, that snowball effect becomes just massive. Because the wealthy deploy larger amounts of capital much earlier in life, compound growth works as this unstoppable engine, constantly accelerating their net worth. Beyond just compounding, having capital acts like a giant magnet for opportunity. During a market downturn, the wealthy use their cash reserves to scoop up businesses, real estate, and equities at a massive discount. Meanwhile, those without a financial safety net are unfortunately often forced to liquidate the few assets they have just to survive, usually selling at the absolute bottom of the market. This dynamic creates a structural advantage that only amplifies during economic turbulence. And, this mechanic perfectly explains the trajectory of the wealth gap. It's a pretty straightforward equation. When asset classes increase in value, the owners of those assets benefit. Those who don't hold assets simply do not. As broad markets naturally expand and property values trend upward over the long haul, wealth inevitably concentrates among the individuals who are already holding the deeds in the shares. Next up is Section 4, thinking in decades. Because our traditional school systems rarely teach advanced financial mechanics, the wealthy make continuous education their own personal responsibility. They spend years mastering crucial pillars: tax strategy, business structuring, cash flow optimization, and risk management.
This specialized knowledge directly translates to better strategic decisions, and, well, better decisions consistently compound into superior financial outcomes. Part of that better decision-making is fundamentally shifting your time horizon. Just look at the timeline here. While the average person chases quick, weekly results or immediate gratification, the wealthy calculate in decades. They understand that market cycles naturally ebb and flow. True wealth isn't a speculative sprint. It's a multi-decade marathon requiring consistent capital deployment and incredibly patient ownership. Finally, we arrive at Section 5, Building Your Own Wealth. The great news is, the actual rules of the game are highly actionable, and you absolutely don't need millions to start. First, aggressively audit your cash flow so you spend less than you earn. Second, deploy that surplus by investing consistently, just completely ignoring the daily market noise. Third, constantly level up your financial literacy. Fourth, laser focus your energy on acquiring assets over liabilities. And fifth, extend your time horizon. Wealth is rarely built overnight, but executing these small actions repeatedly over years produces statistically remarkable results. So, the crucial point is this. Lasting wealth isn't about hustling harder and harder, trading more of your time and labor. It's about leveraging your resources to make your money work tirelessly for you. I want to leave you with a lingering, provocative thought to help audit your own financial habits. Look at your outgoing transactions this month and ask yourself, are you just spending your money, or are you actively building assets that can grow your lasting wealth? Think about that for a second. If you found this explainer helpful in breaking down these mechanics, please let us know what complex topic you'd like us to explain next.